Hi, and welcome to Bullworthy.com. Today, in about 5 minutes or so, we're going to explain to you some different principles and guidelines to follow when investing for dividends. Well, what exactly is a dividend? It's very simple. When a company is in business, they're in business to make a profit, and if they make those profits, they can either A, invest them back into the company, or B, they can pay them out to their shareholders in the form of a dividend. These dividends are paid by cash, or they can be paid by additional shares in that company's stock. They're declared by the board of directors and only the board of directors, and they're declared when companies have been profitable over a sustainable period of time or expect to be profitable over another sustainable period of time. Cash payments are the most typical types of payments that are done with dividends. They can be paid quarterly or yearly, and they are taxable. They're paid on a per share basis, so the dividend amount is the amount of money that they pay per share that you own. We'll explain to you later exactly how that all works out with the math. They're also paid to your brokerage account. So if you have an online brokerage account like we do, we use optionshouse.com. It gets paid right into either your cash account or it can get paid by additional stock right into your stockholder account. Also, if you're looking to have your dividends paid to you in the form of a check, you can do that as well by contacting your brokerage account. When to buy stocks with dividends? Well, there's a couple of different strategies to use when you want to buy a stock that has a juicy dividend. You can buy before the ex-dividend date. The idea here is that you need to buy before the date that they set up that says, once you buy on this date, you're not entitled to our dividend. It's called an ex-dividend date. So if the ex-dividend date is April 20th, then the last day that you need to buy in order to be able to receive that dividend is on April 19th. You want to make sure you buy before the ex-dividend date, and the ex-dividend date is available to shareholders. Or you can also buy within a few days after the declaration date. When a company declares a dividend for the first time, they're basically saying that we have a liability towards our shareholders, and anytime you see a liability with a company, the stock price drops. So investors will flee because the dividend's getting paid. You think that they'd stay in, but that's not always the case. A lot of times it has to do with shares being shorted as well. That's a little bit beyond us, and if you're interested, give us an email and we'll talk to you a little bit more in terms of what the declaration date means. When do you want to sell stocks with dividends? Well, there are times to sell as well, and the time to sell is when a company cuts their dividend. Companies cut dividends all the time, and they do it very strategically. The idea is that if they need to cut expenses, a dividend is the first expense that they'll cut because it's not an expense that they need to do. So if a dividend has been severely cut, like what we saw this past year in a lot of different companies as the economy collapsed and then subsequently started to recover, we've seen a lot of dividends get cut and a lot of stock prices drop because investors flee if there's no dividends. Here's a chart that we put up for Johnson & Johnson Company. This chart depicts the amount of the price of their dividend per share versus each year that they've declared the dividend. So in 2000, they declared a dividend for 60 cents per share each year. In 2004, that price was then $1.20, and then today it sits at $1.96 per share each year. And as you can see, this chart goes right on up, which is the kind of chart that you want to see when you're looking at your dividend ratios. Now, let's put this in perspective and put a little math on it. Let's say you own 1,000 shares, and in 2000, they declare 60 cents per share. That's going to give you $600 each year. Split it up quarterly, 4 quarters in a year, you're going to get $150 each quarter. Let's take the example of $1.96, which is today's dividend rate. 1,000 shares times $1.96 per share is going to give you $1,960 each year. Split that up into 4 quarters. You're going to be getting a check, cash or share equivalents, paid to you $490 each quarter. Now this is pretty amazing because what that means is this is a 226% increase in the dividend payments over the course of only 9 years. Break that even further, that means 25% increases in dividends each year since 2000. That's amazing. That's passive income. That's money that you did nothing to get other than just be a shareholder. So this is what you're looking for when you want to find dividends. Some different strategies with dividends and how you can maximize your dividend payouts. DRIP stands for Dividend Reinvestment Programs. All the brokerage firms have this, and companies are big proponents of it as well. If you want to take that dividend money and reinvest it in shares, you can actually do it through DRIPs without having to pay commissions on it. So if you get paid cash, you can turn that dividend cash convert it right into shares for the company, and bam, now you're reinvesting in a company. You've increased your position in a company that obviously if you're holding it, you like it, so why not? And you do it at no to low commission costs, so there's some nice advantages to that. Another strategy for dividends can be to create long-term passive income. And when you think of long-term passive income, take the Johnson & Johnson example. Over the course of 9 years, they went from 60 cents per share to $1.96 per share that they paid out to you each quarter, 4 times a year, for doing nothing. That's passive income. That's money in your pocket that you can do whatever you want with. And that's the kind of strategies we want you to start thinking about when you start looking into buying dividends. You want to find big dividends, low stock prices, and you want to find companies that are expected to make money over the next 10 years, because over the course of that 10 years, that dividend could pop up 226% like it did in the case of Johnson & Johnson. Another different way that companies can pay dividends, and it doesn't happen very often, but it might happen to you, and if it does, nice, is payments in subsidiary stocks. Subsidiaries or spin-offs are companies that one company owns. Let me explain. If company A, this happens a lot in the pharmaceutical industry in fact, if company A buys company B, what they can do is they can pay the shareholders of company A in company B stock. It costs less to company A, and for you, for the shareholders, it's just stock right in your pocket. It's just a new stock. There's a lot of advantages to this. Obviously, you're getting shares in a company that you did nothing to get. They just straight gave it to you. So right then and there is the first advantage. Now, these shares are not restricted. You can trade them independently. So if company A, if you're invested in company A and they declare a dividend, instead of paying cash, they decide to give you company B stock, a company that they own. Let's say they give you 50 stocks at 50 shares at $5 stock price. That's $250 if you just sell those shares. It's $250 in your pocket for doing nothing. A lot of times the spin-off stocks are nice because you're going to get paid more than you would if they were to just declare a per share cash dividend. So how do you find companies who pay high dividends? Well, there's a couple of different ways that you can do it. We use yahoofinance.com. A very simple strategy that you can start using now is that you can benchmark a company's dividend ratio, which is the amount that they pay out. In the case of Johnson & Johnson, it's $1.96 a year. And you can compare that to other companies in that same sector industry. So you can compare $1.96 per share to Johnson & Johnson's competitors. Obviously, if you've got company A and company B up against each other, let's say company A's stock price is $25, company B's is 10, but they've got the same dividend ratio, you might as well just go with company B, because now you've got a chance for that stock price to appreciate most likely, and also you're getting the same dividend payout that company A might have. There's a lot more to take into account, so don't just leave it all at that. Do all of your homework on each company and really benchmark every ratio and every valuation against each other. Look for companies who recently declared dividends, because this means that they're confident that in the next to near future, they're going to be not only as profitable as they've been, but even more profitable. A declaration of a dividend is a company basically saying, look, we've been making a lot of money recently, we're ready to give back to you guys, the shareholders, and we're looking to give back to the shareholders in the form of dividends over the next couple of years. We're expecting to see even more profits than what we're making right now. Again, use yahoofinance.com to find all this information. It's free, easy to access, and very easy to use. Visit Bullworthy.com for more information on who we are and what we do. Browse the web pages. If you have any questions, comments, concerns, you can use the live chat button. Additionally, you can email us at tom.copeland@bullworthy.com. Remember, build yourself a fortune with Bullworthy.com.